Let's broaden the conversation out to the broader markets, but also to get a bit of a perspective on the Canadian dollar as well. We are going to the TSX Broadcast Centre in downtown Toronto. Diana Avigdor is joining us. She's the head of trading at Barometer Capital Management and a PM. Diana, good to be with you today. Thanks so much for joining us.
Hi, Catherine. Thanks for having me.
Let me first get your take in terms of this move in the Canadian dollar, and if, in your opinion, it was expected or unexpected.
If it was expected or not, well, with the rates in the U.S. going up, if you expected rates to go up in the United States, or when you expected rates to no longer go down, and started seeing the flows, you saw that the U.S. dollar was starting to rally off a decade low. So if you thought that the U.S. market was normalizing, and with real rates in the U.S. still negative, actually, it makes sense that the U.S. dollar would rally. Now, like Greg Bonnell said earlier, the Canadian dollar was going hand in hand as a North American currency. This is a developed market recalibration. But then when oil could not break up 55 and flow started to turn negative, and all these oil inventories and the commodity markets selling off, that put further pressure on the Canadian dollar. And with commodities not working, it's not surprising that the Canadian dollar flows are not materializing.
Diana, what are your expectations, though, in terms of the CAD-US dollar value and relationship more towards the end of the year? And one of the key reasons why I'm asking you is because so often when we have guests on BNN, they do talk about having a greater weighting, a greater exposure to the U.S. market. And the tough pill to swallow, of course, is if you've got Canadian cash, you don't have U.S. dollar cash, you want to buy those U.S. stocks, you have to convert. And so I'm asking you, from your perspective, your team's perspective, do you convert at these levels? Do you wait it out? What do you do?
Well, we stay long the U.S. dollar in our U.S. investments. You're able to, of course, hedge it back. You're priced in Canadian dollars. And so when you make a foreign investment, you also make an investment in the local currency. In this case, we're talking about U.S. dollars. We can hedge it back and neutralize that. But for now, we don't really see that much of a reason. Catherine, if commodity markets stabilize, if, say, just let's speculate that global growth gets on to be on such a strong path that is the bigger factor driving the commodity market, it's possible that all that is going to reverse. Hedging in today's market, hedging a currency in today's market is neither hard nor that expensive. So it's possible to do it in a day. And so we have the luxury of waiting it out for now with rates in the U.S. going up. With the economic numbers the way they have been, there's no reason to hedge our U.S. dollar exposure.
What's your view in terms of the commodity complex? Do you think that global growth is looking better? It seems as though the numbers would indicate that out of Japan as well as Germany, even China today. What do you think?
My blue sky scenario, I think, and our blue sky scenario would be that growth is positive and slow so that the recovery can be prolonged, so that we can be in a great market environment for longer. Now, that being said, if it's a little bit better, that would be good. I'm not sure. I think that you need a lot of growth in order to offset the extra supply that we have in the commodity markets.
Let me ask you from an asset allocation perspective, particularly looking at geographies, where do you want to be more weighted? And I know you and I have talked for years now, and I know that you have certainly favored and benefited from going long the U.S. Equity markets. But what are you thinking right now in terms of Europe? Are you buying into Europe? Are you buying into the discounted valuations that they might offer versus the United States at stretched valuations? Are you making any of those moves right now?
I totally understand the question. I think it's a very fair question. We're not overweight Europe yet. Certainly it's a place to look at. From a valuation perspective, it is cheaper. But valuation is something that, so in the US financials, for example, we were just talking about it this morning. Some US banks are trading at 1x book. That means that you're not giving any value to the business. You're basically buying a bank at liquidation value, sell all the mortgages, all the assets, and that's the value. So they're very cheap. Canadian banks are returning over 15% ROE. at over 10 times earnings. They're not cheap, but they're not cheap for a reason. They have a yield over 4%. In Europe, I think that you're right. There is certainly some valuation advantage. You have a currency, though, that you will have to hedge because it may not be as strong. And you do have some election catalysts or risks, headline risks that are coming up. I think from a developed market perspective, when you have a market like in North America that is doing well, I think you're taking on extra foreign exchange and international risk to be in certain other markets despite the valuation.
So you're staying the course, it sounds like, in those U.S. banks and the Canadian banks as well.
U.S. banks, Canadian banks, industrials, technology.
A lot more than I just said. I want to get your view, Diana. It is International Women's Day. Both you and I have worked on Bay Street, Wall Street. And I don't know. I'm wondering, A, what your experience has been, and if you'd want to even share some of the, you can't share those stories, but you know what I mean. And or any advice to women on Bay Street or Wall Street?
You know, I think that I haven't had many bad experiences on Bay Street and doing the U.S. market as well. It's true that it is mainly male-centric, especially on the sell side, but not on the buy side, not on the investment side. I've met some fantastic women portfolio managers and some fantastic women traders, especially in Canada here.
Yeah.
I think that there is a different way of thinking, and I think the two sides have to equalize. Women like to be more consensus builders. They like to be consensus gatherers. They like to seek information and think horizontally, whereas the decision-making process is a little slower. I think that women have to speed up their decision-making process a little bit, and I do think that the world has to understand that we think differently, horizontally, laterally, and consensus building like. So I think that I think we've gone a long way. I think the world has gone a long way. I think I'm not sure how comfortable I am with a quota of hiring women, if you know what I mean. But my experience has been okay. I think that time mobility is certainly an issue. I think that if from a not from a finance but trading perspective, it's hard to have time mobility.
What do you mean by that?
Like, for example, you can't say I'm going to leave today at 2 o'clock and I'm going to work today at 8 because market's open.
Right.
So from a trading perspective, you can't. But from other perspectives, that's time mobility. I'm going to take those 2 hours and I'm going to work at 8 o'clock or at 2 o'clock or at 4 o'clock or so often we don't have time mobility, but often it's also a perceived lack of ability for time mobility. And I think if that opens up, I think you're going to have a lot more women stay in the business.
Yeah, that I think that's the key word. I'm going to be discussing it a little bit later with Jennifer Reynolds, head of WCM. But the key is staying in the business. A lot of people want to leave because at a certain point it does get tough, and it gets tougher as you get a bit older.
Yeah.
But the key I've always said to people is just stay in the game. It's a great
Stay
game.
in the game. It's a good game.
It's a
It really
great
is.
game. I'll talk to you later, Diana. Thanks so much.
Bye, Catherine. Thanks for having me. Bye.